If you want to retire today, you're going to need to die in about 5 or 6 years. How many of your clients are truly financially free where they don't worry about money? Well, none. They all worry about money. How about this? How many of you guys as financial advisors are financially free, not off the commissions, but actually doing these investments? It's always like getting your money away from your power and your possession when you know you could be a wiser steward of your money. I had enough passive income by June of 2006.
All right, everybody. Welcome to another episode of Raw Relentless. I've got Chris Miles on. Chris, thanks for joining us, man.
It's a pleasure to be here, Bo. Thanks for having me on, man.
Of course. Why don't you tell the audience a little bit about yourself, what you do, what you're all about?
Yes, I'm often referred to as like the anti-financial advisor. A lot of the financial advice you get out there is BS, right? But that's because I actually started out that way. I actually started teaching that kind of BS myself. Funny story, I actually was planning on becoming a business consultant. You know, that was my whole goal. I want to be like the Bobs from Office Space. Have you ever seen that movie?
Yeah.
I want to go and consult them, tell them what they're doing wrong with their company, and then go walk out with a big paycheck. But as I was in college, I thought, well, I should probably have real life business experience before I just tell a bunch of people twice my age what they should be doing with their business, right? Mm-hmm. So I decided I was going to take a sabbatical from college. Actually dropped out and said, let's find some business. And the first one that came up that intrigued me was being a financial advisor, because I figured worst case, I learned about investing, money, and maybe I can even help my cheapskate dad, you know, the guy that, you know, raised me to spend nothing, save everything, you know, and we can't afford this. We think I am made of money. Money doesn't grow on trees, you know, all that kind of stuff he would tell me. And even like he would tell me that his job would kill him, literally. Like he's like, man, like I've already had strokes and heart attacks in my 40s and 50s. This job will kill me. So I figured, let's do that. And I ended up loving being in business so much, I never went back to college. I stayed dropped out. I decided I want to go down that path. But 4 years in, my dad reaches out and he says, Chris, well, tell me, is like, how do I retire? I'm 61 years old. I want to do it. And so I go to his house, you know, but, you know, I grew up in Oregon, you know, I live in Utah now. But I go to his house and I look at his money for the first time in my entire life, because he was always so guarded about people trying to take money from him, right? So I look at it, how he had been hoarding money. I saw that he had paid off all of his debt, including his house. So 100% debt free, saving in his 401k, getting the pretty little match that they always tell you you're supposed to get, the no-brainer match. And as I look at everything, I said, Dad, if you want to retire today, you're going to need to die in about 5 or 6 years, because that's when you're going to run out of money.
Wow.
He's like, okay, that's not what I wanted to hear. I want out of this job, right? That's killing me. And I said, I don't know. I don't know what to tell you. You did everything right from what I teach as a financial advisor. I'm like, your only goal is maybe, you know, keep saving, work until you're 70, you know, and I mean, it's not ideal, but that's probably your option, or die faster.
Yeah.
You know, not a great option either. And I walked away really upset, because the very guy that kind of inspired me to want to figure this stuff out, and, you know, for myself and him, because I realized I was on the same path as him. I was being cheap. I was, you know, turning on the AC in the summer and turning off the heat in the winter just to save a few bucks, and so I could put it in my mutual funds and all that crap. Yeah. Only to find out it wasn't working. And it became apparent the next month, because I'm talking with a friend who I hired to be a financial advisor, but then he quit to go do real estate investing. And I'm talking to him. He's like, well, Chris, how many of your clients are truly financially free where they don't worry about money? I said, well, none. They all worry about money. Even if they're retired, they still worry about running out of money too soon. Okay, great job. How about this? How many of you guys as financial advisors are financially free, not off the commissions, but actually doing these investments? I'm like, well, I don't know. There's guys been working here since the 1970s, so probably none.
That's crazy.
There's the problem. And that's when I started going down a different path. You know, I started looking into things like alternative investments, you know, passive income, real estate investing, all the things you hear about in Rich Dad, Poor Dad, you hear about, but you're not really sure how to do it, right? Yep. I started learning those same things, quit being a financial advisor in 2006. I said, I'll never teach about money again. I'll just be a mortgage broker, and I'll teach ballroom dancing on the side, right? And so I was doing that kind of stuff. And then later that next year, I was 28, almost 29 years old. I was able to actually retire. I had enough passive income coming in. I was able to quit. And
at 29 years old.
Yeah. And I wasn't even 29 yet. It was just 3 months before I turned 29.
Wow.
And I was like, dang, that was way easier than I thought. You know, especially because I was of the mindset, you just set it and forget it. You just keep squirreling your money away forever, right? Which, you know what it is. I mean, we're all business owners. I mean, getting financial advisors, like it's like the worst thing ever because they're the ones that tell you, hey, invest in every other company but your own, right? They're the ones telling you like, just lock it away, put it into prison. You can't get to it, even if you want to get to it. And if you try to get to it, you get slapped with penalties and taxes and all that kind of crap, right? I mean, think about it. I mean, it's always like getting your money away from your power and your possession when you know you could be a wiser steward of your money, especially as a business owner.
Yeah. And at this point, you've been a financial advisor for what, 6-7 years?
It had been 4 years. That was a 4 years
so short time
advisor. So it was just literally like a few months after meeting with my dad that I was like, I'm out. I'm done. I'll never teach about money again. And, I'll just be a ballroom dance instructor and do mortgages. Right. And
so within those 4 years, you were able to kind of pivot 180 degrees and retire in that short amount of time, from passive income.
So if you think about it, I met with my dad around Thanksgiving holiday of 2005. I found out I had enough passive income by June of 2006. So
wow.
Not much more than a half year later or so. Now, granted, I only needed like $3,500 a month to live on back then because I had a very young family. Now I've got like an entire village of kids, but it was a lot easier pre-inflation. Well, there's always inflation, but it was easier back then. Like for example, my dream was $5,000 a month, which is what I got to. I got to about $4,000 or $5,000 a month, and I thought that would be like living the high life forever. Which now, 20 years later, you're like, oh, $4,000 or $5,000 a month is like barely over poverty line.
Yeah, that's barely a mortgage payment nowadays.
Yeah. So yeah, I mean, eventually people kept asking me, well, how'd you do it? So finally, 2007, I came, I was getting bored. I didn't know what to do with my time. In fact, I kept doing like little side hustles and stuff just to keep myself busy because I was going nuts, like not doing anything. But finally in 2007, came out of retirement to teach people how to do what I did until the recession hit. Then I went broke, over $1 million in debt, and had to dig out of that debt hole to retire again the second time in 2016. So that's basically my story in a very quick nutshell, but that's what I've been doing ever since, is really helping high income earners like turn their income and their cash into passive income so they become work optional. They work because they want to, not because they have to, right? So then they can do whatever they want with their time.
Yeah. So basically what you're doing, we talk about this a lot on the podcast, especially with the real estate investing, is just leveraging your money into passive investments like real estate. And there's so many different asset classes in real estate, which I assume is basically what you did, right? You just kind of syndicated your money and bought into various real estate asset products, whether it's multifamily, self-storage, industrial, whatever it might be, right? And then you just get the passive income from that, correct?
Yeah. And now back then, I didn't even know what a syndication was, I was pretty simple back then. It was like, I turned my starter home into an actual investment, like into an actual rental property. Funny thing, I actually sold my rental to an investor at full appraisal, leased it back, and then subleased it so I could rent it out again, right? So I was able to strip out all the equity up to 100% and then turn around and rent it back out. And then I was doing like hard money lending because 2006, people were a little bit overly confident in the real estate market. And so, I mean, there's people paying like 2% or more a month. I mean, it was like 25, 30% a year for hard money lending. So that helped. I mean, now if you find 1% a month, you're like, that's cool. I'll take it, So it was a different game back then, but that's pretty much what it was. It was like rental and then like, hard money lending. But 2016, when we flash forward, beyond 2016 and things like that, as I was able to have enough passive income again, I mean, now it's like I was doing turnkey rentals, right? Because I realized in 2006 through 8, while I had a rental property, I was a horrible property manager. I would take every sob story possible and not take payments, which is not a good thing if you're trying to do real estate. So I realized I was a crappy property manager, and I realized in the western half of the U.S., rentals suck. So I was buying out east, like southeast and things like that, buy rental properties like turnkeys. Definitely still doing hard money lending, but different ways, or it could be a debt fund. Syndications, it could be multifamily or whatever, or like you said, industrial. I mean, self-storage has been it's been kind of bad like apartments, but it hasn't quite lowered in the price that it needs to be a good deal again, so it's been harder to find good deals there. But that's the thing, like, as the years went on, I'm like, man, there are so many ways. I mean, raw land. I have a raw land partnership right now where, again, they do all the work. I'm a 70% partner because I finance it all. But I mean, that's been awesome.
How does the raw land deal work?
Yeah. So what it is, like, they're basically going and buying raw land at wholesale price, turn around at selling at retail on terms, right? So they'll sell it at like so like I had one just recently that we bought for about $7,800, turned around and sold it for just about $30,000. But then it's like a 10% interest for the next 10 years, so it's basically like a mortgage payment being paid to us. So it's principal and interest, obviously. So I try not to like, even if you do take out cash, I'm not like taking the full, almost 13,000 a month I'm now getting from the $500,000 invested over the years.
Yeah.
But still, like if I pull out cash, I can either pull out 5,000 a month, reinvest the rest, and just keep growing that portfolio even by little bits. Even as some pay off, new ones can come in, and keep that income at least stable or growing.
Yeah, I mean, there's so many ways to make money. I mean, I think that's where most people lack the knowledge that you can even do this kind of stuff. I recently had somebody walk up to me in the gym, and they're like, "Hey man, I was listening to your podcast, and I'm interested in learning more about how you're doing your investments because, like you said, people mostly are like 401k, IRA, invest in a mutual fund. And then like your father, by the time they're ready to retire, there's just not enough there,
That's right. Yeah, it happens all the time. And you're right. I mean, I was a financial advisor for 4 years. I never heard of anything like that. I mean, there were so many things I was learning. I mean, even that's the first time I heard about like infinite banking and things like that. I was like, what's that? I was like, buy whole life insurance. I'm like, whole life insurance, that's like the worst thing you could ever buy. Because I didn't know what whole life insurance really did or was, but as a financial advisor, that's what I was brainwashed to believe, right? I mean, so like all these things, I mean, it was just like it was really like the Matrix for me. Like it was like I took the red pill and this whole new world opened up that I didn't know was possible. And that's really what drives my passion because you're right. Most people think they equate investing to mutual funds or stocks or bonds. That's all they think there is because what I learned as a financial advisor is the wizard behind the curtain, right? Who's basically full of crap, is that I was not licensed to create wealth for you. I was licensed to sell you a product. I was licensed to sell you very specific things. With the insurance license, I could sell you insurance. With securities licenses, I can sell you securities like mutual funds and whatnot, right? That's all I could sell you. I was licensed to sell, not licensed to create more wealth. And when I finally broke free of that, when I finally realized that it was a joke, right? And again, I know those guys are good people. Not to bag on them too much because I thought I was helping people. I was trying to do my best to serve people the best way I knew how. But when I realized that taking high risk to create mediocre, maybe 8% returns in the stock market is just ridiculous, and people buy it hook, line, and sinker. And I mean, you ever notice like dollar cost averaging? I heard my wife play a video with Dave Ramsey last night, and I was just like, that's a bunch of BS. I'm gonna try not to say what I actually said, but I basically said,
you can.
I was like, that's bullshit. Like, come on, because because he told the guy, he's like, when the market goes down, if you're a good investor, the market goes down, you're happy. And I was like, oh, there it is. And he's talking about dollar cost averaging. I was like, no, because in that world, they tell you if the market goes up, they say keep investing. But if it goes down, keep investing, right? Isn't that the most brilliant marketing strategy ever? Like, it doesn't matter if it's good or bad, you should keep buying. And if that were to happen in real estate, right? I mean, we saw the last 3 years with like multifamily, especially in commercial stuff. I mean, man, people are scared out of their minds to be in it. And the stock market goes down way more often than real estate does. And you don't see nearly the fear because all these stupid idiots out there like Dave Ramsey, who obviously is paid to do that. By the way, Dave Ramsey, he has arguably about 200 million of net worth, right? There's people that say, oh, he's worth 700 million or $1 billion. No, he's not. Like I researched it to death. The best I could find was about 200 million, give or take, of net worth. Here's the crazy part. 52 million is roughly the value of his business depending on the day. Because without Dave Ramsey, it's still not, even if he claims that he's got people in charge, it's built around him, right?
He's the brand.
He's the brand. So 52 million, which is nothing. Trust me, that's still amazing. But the other 150 million is real estate. Paid off real estate that he's owned, not mutual funds, right? So he's telling everybody else to do the opposite. Do what Dave Ramsey did. If you would stop listening to the BS coming out of his mouth and do what he did, you wouldn't be following his advice. You'd be doing what he's done, which is buying real estate. Now, I wouldn't buy all free and clear real estate. Like there's something to argue about, using leverage, especially when you're trying to build that net worth first. Like
Absolutely.
he's made all of his money in his business. He didn't
Yeah.
make his money in the stock market like he's claiming people will. And that's what makes me so mad is that people are told to throw the money in 401k. I also did more research on the 401k, specifically Fidelity, because right now over 85% of people put their money in those target date funds, right?
Yep.
The
Yep.
fund that says, the Fidelity target date 2035 for those retiring sooner, or target date 2060 or whatever it might be. And people are just going to that. Did you know the last 10 years, I actually measured it, that those target date funds underperform the stock market by about 2.1%.
Yep.
On top of that, they also have at least a minimum of 0.75% fees associated to those target date funds. That does include all the other admin fees they might throw on as well.
Yep.
So that means you got roughly about a 3% worse performance than what you get just buying the S&P 500. Here's the crazy thing. The S&P 500, I've done the math the last 30 years, from 95 till 2025, June to June, right? You did an 8.4% return. So if you do the math on that, you say, great, well, that means maybe my 401k did 5.5%, in those funds, if I were over that same period of time. So here's what's crazy. If you get a 100% match, guess what it adds? Roughly about 2 or 3% long-term compounded return. That means that you would perform the same way if you just bought your own mutual fund in the SP 500 as if you did the 401k with a 100% match. It's the same.
Wow.
But all these people are brainwashing you, telling you the 401k is a no-brainer. You set it and forget it, right? You just put it in there. You just get that match because it's easy money. Why wouldn't you take free money, right? You hear people say all the time. But what they don't tell you is the 401k underperforms. Those funds underperform so badly that you need the match just to make up for the bad performance.
Right.
That right there is not taught right now, but it should be. And that's why I'm getting so pissed. Like when I see, especially now, like you got the rising generation on TikTok and Instagram, man, they're like teaching all this stuff saying, oh yeah, you've got to put your money in here. They're teaching the same thing that I was taught when I was in my 20s. And it hasn't worked yet. People are still retiring broke, like my dad, right? Like so many other people. And people say, well, I know somebody who's saved their way and they've made 2 million or 3 million. Maybe they've saved more than 3 million over the last 30 plus years. Here's the problem. If you go by traditional financial advice, you're only supposed to pull out 3% a year if you're in your 60s retiring. Do the math. 3% of 3 million is 90,000 a year in today's dollars. That doesn't even count inflation or anything else, right?
Yep.
But they're saying that's what you can pull off. Everybody talks about the 4% rule. That 4% rule was debunked years ago. If 4% only works if you're in your 70s now, because people are living longer, there's higher inflation than there was in the 1970s when that rule was calculated. And so it's a 3% rule. Worse, if you're trying to be the FIRE movement guys, you hear those guys all the time, right? I had a friend he sells to real estate investors, 30 years old, saved $1 million. He's like, yeah, I'm financially free. I'm like, well, how do you know? I've got $1 million, 4%, I can live on 40,000 a year. I'm like, do you know at your age, that 4% rule doesn't work.
Yep.
It's a 2% rule. It's 2%. He's like, are you telling me I have to save $2 million to live on 40,000 a year? I'm like, yeah. Because of inflation and everything else, you wouldn't be able to keep up that longer term. 4% rule is never meant to last that long. He's like,
just look at the price of homes in the last 5 years.
Yeah.
And the price of cars in the last 10. I mean, 20 years ago, you could go out and you could buy a decent car for $25,000. Now that same car is minimum $50,000.
That's right.
Right. Plus, did you ever read, I don't remember the name of the book. Tony Robbins wrote a book several years ago about this exact subject because he pushed for people investing in index funds and ETFs because of exactly what you're saying between 401ks and mutuals. The price that you pay in admin and management fees, I can't remember what the, I want to say off the top of my head, it was something like the average person loses $500,000 of valuation in their portfolio just in management fees that they pay out over the course of their investment. I mean, that's huge. $500,000 that you lose. Whereas if you invest in index or ETFs, it's a fraction of that.
That's right. And even then, I don't think it's very good because they can tell you it's 10 or 12% rate of return, and it's not. It's not. I've literally gone and plotted the S&P to figure out the real compounded rate of return of the market. And it's been 8.4% for the last 30 years. And by the way, that's one of the best I've seen as I've been tracking it for the last 20 years. So I've been going in, if not monthly, at least every few months, tracking the S&P. Usually it's between 7 and 8%. It's typical. But because we're at an all-time high as of the date of this recording, that could change in a short period of time. But right now, it's an all-time high. The problem is that that's the high from a low that was around 95, or like a little mini recession back then, right?
Yep.
So it looks better now.
Yep.
But what happens when it switches? What happens if the market comes down to where it should be, which is at least half? It's about half of where it is today. Like it's double the value of what it should be. And that to me is scary, because everybody's kind of led into complacency thinking that the market works great, because since 2009, there's only one down year, which is not typical. Usually you have 5 years up, 2 years down, but in the last 16 years, it's been 1 year down only.
Yeah.
You know, we are way overdue for a correction.
Way overdue. Yeah. Which they say it's coming at the end of this decade.
Yeah. I think it's coming this year, honestly.
Do you really?
I mean, the only way it would, I could be wrong, of course, because I've been wrong so many times. I remember I called a recession in 2015. And then when Trump got elected, it shot up again, right? And then I called it again in 2019, because all of us as real estate investors were like, it's coming, it's here. Even the feds were lowering the rates in preparation for a recession. And then 2020, the feds literally infused trillions of dollars of cash to overinflate our market, right?
Yep.
If they do the same thing again, they could kind of pull us, quote unquote, out of a recession and just make the bubble longer and bigger, and that just means eventually it will pop, right? But yeah, that's the only thing I think would happen. I think right now we're going to see a correction in the stock market, especially. I think there's already things slowing down the economy that we've got to be aware of. And I mean, again, nobody's like talking about that necessarily, other than the few voices in the wilderness, right? But it's coming. I think it'll come much sooner than the end of this decade.
So if investors come to you and want to invest with Chris, what are you typically offering in terms of returns for a lot of your investors?
Yeah, we just go for purely passive investments. I mean passive. I don't mean like, hey, become a wholesaler, work 40 hours a week and you're passive, right? Like not like that, which is fine. Like you make sick amounts of money there, but it's not passive. And so we do just take your money to go and invest. Typically 10, 12% returns is what we go for. I like the more certain bets. I mean, I'm not opposed to people doing some speculative stuff, but don't gamble all your money into that. I have one guy that I just talked to yesterday that's got like 700,000 in Bitcoin.
Wow.
And he's a military guy, right? So I mean, he's like, I don't have many other assets. He's like, I've got a little cash. He did invest in some real estate. He sold off a property. He's getting like 300,000 out of it. He's like, yeah, I got this other about 650,000 or so of Bitcoin. He's like, but I don't want to lose it. I'm like, dude, if you capture your gains now after all the money you've made, you don't have to sell all of it. But if you sell some, you could do some sick things right now to create massive wealth. Diversifying into real estate versus being so heavy, because you're overly heavy in crypto. So that's what we go for. Like, it was like, how do we like diversify? So like with him, it's like, let's look at some, types of lending, whether it's individual notes or a debt fund or something like that. Obviously lending has been very popular lately because it's actually been paying, unlike, some of the turnkeys were great 3-4 years ago, but now they suck, even though I still think long-term they're better in a lot of ways. Still, it's a rough go even on the single family space. I actually think multifamily is coming back, so we're starting to look at that. But industrial. It's
been a struggle, man. I mean, we as a syndication, it's been hard trying to find deals. I mean, like you were mentioning with self storage. I mean, rates were so low, and I agree with you 100% on this kind of mini multifamily bubble that I think is going to happen, because so many sponsors were buying with bridge lending, which is a variable rate loan, and then it comes due, and they were buying when rates were at 2.5-3%, and now that prime is at 6 and whatever it is now, I don't even know, but their rate is basically tripled, and they're like, oh shit, right? So they don't have that, they don't have the cash flow to be able to sustain the debt service. So a lot of these guys are defaulting. I think you're going to see a huge shift, but it's still really hard to find a deal.
It is. No, I agree. I think the prices are finally getting to where they're decent, but like you said, like you almost have to find those distressed ones, and they have to have enough equity. And that's the thing I think is kind of like robbery, right? I mean, those rates went up so fast, it killed the cap rates. And then naturally you watched, even if you had 20% equity in a property thinking you're safe, it disappeared.
Yeah,
almost
exactly right.
not overnight, but over 6 months,
Yeah.
And so, yeah,
Well,
like
I always say in the business world, like things move very fast. They change very, very fast.
yeah, yeah, I totally agree. And so I'm like future bullish on looking at like multifamily and stuff like that. More like industrial on the syndication side. Like there's definitely some things there, even sometimes in the commercial space, because they've either one, they haven't been affected by it, or two, they already went through that, the trash.
Yeah.
I like to sometimes go for things that people have been scared of. That's always a good play to go to. But yeah, overall, I mean, that's pretty much been more like what's cash flowing right now, which has been mostly lending or debt funds, or anything like that. I've even seen some guys that were syndicators now moving into just doing debt. They're like, no more like no more pref. Like I'm just doing almost like I'm doing a pref only, no equity gains. Like I'm just going on the debt side and keeping it simple. And
Interesting.
that's great. I mean, that's fine as long as the numbers still play out and work. And that's all we do. Like we don't raise capital ourselves. We're just really strategists, like financial strategists, and we're connectors, right? And we try to connect them to those deals, to say, based on your goals and what you're going for, because we just charge a client a consulting fee to do that. And then we try to match make them a little bit. Say, here, we're not giving you any advice. We're not going to be investment advisors, right? But we're going to say, let's narrow down some of your options. Here's some of the better plays for your situation, what you're going for. Here's some people that have been trustworthy, have had great track records over the last several years. And that even includes, multifamily. I've had syndicators that never had a loss for 20 plus years. And then this time around, they had their first like deals that went south, and may not have been all of them, but a few of them at least, and that's the thing. So there's always risk, and we always let them know that, but it's really just trying to help clear out all the obstacles, right? Because the one thing I don't, I know there's like people out there that sometimes will have like their own little mastermind groups, and they'll like, here's all these people you can go to, but usually they only put them in their group because they get paid for it, right?
Yeah.
Not because they're the right people, or that they're honorable, or that they're not like the bad. There could be some bad actors in there, right? There could be some people that are not good operators, just because they're willing to pay money to that mastermind leader, and I'm being kind of blunt and calling it out, but I've seen that too often, and I've seen some of those groups, people have like lost so much money. Like I saw one guy that I know, that man, almost every deal in his group, especially because it was very heavy with one particular syndicator, lost, like people had lost millions of dollars, like individually losing millions of dollars, like doctors and dentists and stuff.
Oh, geez.
So you got to be careful of that. And that's why I'm very guarded, like that's why I'm like, okay, I want to make sure that these people have been through full cycles. They've had their teeth kicked in before, at least once, if not twice, through different market cycles, so that they know what to look for. They're wiser when they're doing their deals. And that's been good. And so we're doing that, but we're also doing things like, I couldn't find anybody to do it consistently, but we actually brought in 2017 in-house what we call max ROI infinite banking, which is a nice strategy when it's low cost, basically lowest cost possible to get the highest return in your policy. Using that in coordination with the real estate investing, or just if they're just trying to store cash on the side as dry powder or just emergency funds or whatever it might be, but not the typical stuff you see on social media where they're like, buy a car with it. It's like, no, I'll use the bank to do that because I can get a better interest rate anyways. And I don't have to use my own money. So I'm going to do that, So
I'm glad you brought that up, because that is a huge, that's a huge social media gimmick, right? That's going around where they talk about infinite banking, but correct me if I'm wrong, what most people don't realize is the cash value of the policy has to be pretty significant in order for you to achieve that infinite banking status, which means you got to dump a lot of cash into the policy to get there, correct?
It can be, depending on how they design it. Because so I mentioned like when I first got into that real estate world and I took the red pill, all these guys were talking about this infinite banking concept in 2006. Now, that was when I was young. It wasn't in social media because, we didn't have social media. We had a MySpace, I think, maybe by that point. But I remember buying a policy from a guy, and I looked at it. I was like, this is expensive. Like, it looks like I don't have any cash in this thing for 3 years. And he's like, yeah, well, that's just how they are. But it's front loaded, but then it gets cheaper as time goes on. I'm like, all right, I'll just trust you because all these guys seem to like it, so I'll do it too. 2008 rolls around. I'm in the whole $15,000 a month. Like I'm short between my business and my personal expenses. I can't afford to keep paying $1,000 a month into this thing. And I end up losing the policy.
Wow.
I found out just months later. And now understand, I had a life insurance license. I didn't drop it. I still had it. But when I started to do my own research, I found out that the guy lied to me. Because I even asked him, I said, can I pull levers to make this better? He's like, no, you'll get taxed if you do. I'm like, well, I hate taxes, so let's not do that. But when I started to do my own numbers, I realized he lied, that I could have actually pulled different levers and had cash in there from day one, so I don't have to put in as much cash to be able to leverage and use it, right? And I confronted him about it. 2-hour debate, because he's like, well, the death benefit's important. I'm like, fine, I'll match your stupid death benefit, which I don't really care about as much anyways. Did all that stuff, matched it. I still beat his numbers. And he says, Chris, I did it that way because I could not afford to cut my commissions. I'm like, there's the truth. Got to it. That guy now works for a bank. He's no longer even in the business. But I've seen that too many times. And even the guys that are infinite bankers that maybe pull some of those levers and make it better, still, they don't do the best, right? Because some of them will say, oh, 60% of your money goes in the cash in the beginning in that tax-free savings account, right? The other 40% goes to pay insurance costs. But I found I was like, no, I could do it like 80, 85% going in the first year, only 15 to 20% coming out in cost. And that's the most expensive year. By year 3, it's already paying for itself. You know, like it's like free insurance at this point.
So that's what you mean by pulling levers, where you're putting more cash in up front. Okay.
Yeah, but I'm not like dumping cash. There are some guys in the real estate space you got to be aware of that, again, friends of mine. So I'm not trying to bag on them too much, but I disagree with their strategy where they'll say, hey, dump in a bunch of money up front and then you can leverage it right off the bat. I always look at things from an investor, business owner standpoint. I like biggest bang for my buck, best ROI, right?
Yeah.
And because I design it the way I design it for myself and for my family, where a lot of these guys will give you one thing, but then do it differently for themselves on another. And so like, give you an example. I had a real estate investor in a mastermind group I'm a part of, and he was told to put in $750,000 up front and then pay $250,000 a year thereafter. And I told him, I was like, I'm not a big fan of doing that big dump in year 1 type strategy, because that's the most expensive year. That's where most of the costs come out. I'd rather have you spread it out. And when I looked at the guy's cash flow and everything, I was like, you know what? I think you should just do $250,000 a year, which will reduce your costs by 2/3. Like it'll be just 1/3 of the cost versus what you're going to be paying. I'm like, yeah, you won't have as much money up front day one, but the money you're putting in, more of it will be there for you. You know? And by the way, I mean, I see some of these people like dump it all in and then invest it in year 1. No, I don't do that. I actually teach my clients, I teach them instead those first few years where there is a net cost. I was like, instead, just use your emergency fund to fund it. Don't use the money you're going to invest in real estate. Just use cash out of your pocket. Because the biggest argument against infinite banking is, well, if I throw in, say, at best, let's just say I throw in $250,000, I might have $200,000 or so to leverage and use, because 40 or 50,000 is going to go to fees, right?
Yeah.
Well, I mean, so a lot of people say, well, why not just invest the full 250? And I 100% agree. Like, invest the full 250, but you got this emergency fund. You're not going to be investing that money. Use that money. Just like people transfer from their crappy bank point nothing percent account to a high yield savings account, do the same thing. Transfer into this, because it is tax-free high yield savings account. It's paying 6% a year right now. Tax-free. That's way better than 3.5% taxable you're going to get for these high yield savings accounts. So move the money over, and do it gradually. And then eventually by the 3rd year, because it's making more than what it's costing you anyways, like it's growing more in cash than what you're paying into it. Great. Even if you put in, say, 50,000 or whatever, you're going to be able to pull out the 50,000 right away anyways. So it's like a zero net cost that you can still leverage and use. And you got a couple years, you can keep investing all of the money you want into your real estate. So I do it differently. I have a very different method. The only reason that those guys like you to dump it up front, to be perfectly honest, is because the highest commissions are in year 1.
Yeah.
So if you dump in that $750,000, that guy's getting paid a percentage of that $750,000. No wonder he's so hot and bothered by it.
Yeah, gotcha.
Versus doing the $250,000, it really cuts your costs in 1/3. And that's what insurance agents get paid off of. And again, it comes right back to what that guy told me. I couldn't afford to cut my commissions. So many guys will say, I'll cut it a little bit, but not all the way, right? And we're just like, no. Like I tell my guys, like, listen, if I find out that you even pad it a little bit, you're out. You're fired. Like no warning. This is your warning, your verbal warning. You're out. If I find out you're trying to, you're not giving people the absolute very best what's possible in a policy.
Yeah, so I love that.
That's why I end up taking it in house, because every time I trusted a friend to do it, every time their self-interest would get in the way, and I'm like, man, like you're not giving my people the best. If I can beat your numbers,
Yeah.
Like playing with my own numbers, you should be the expert, not me. You're out,
So one last question, because I know you've got to run, and which I really appreciate you. This is so much good information, such solid stuff. Somebody comes to you, Chris, and says, "Hey, man, I still want to keep working, but I want to be like you, where I get enough passive income to maybe cover my overhead expenses." And let's say my overhead expenses are, between mortgage, car, kids, all that stuff is 10 grand a month.
Yeah.
What would you tell them to do?
Get lean, get liquid, get out. That's the 3 pieces of advice I give to everybody, especially since 2020, right? So get lean means that you're being a wise steward of your money. It doesn't mean live on rice and beans or cut out that latte, as those guys will say, but it's really about what can we actually do to be wise with our money? If I'm spending my money, how do I prioritize it in ways that I want to spend it in those places? If it's vacation, great vacation, but just make sure that you're living on less than you consume, right? Like you actually are consuming less than you produce, and find ways to produce more income. So get lean.
How much would they need to invest if they wanted to try and achieve that 10K a month in passive income?
Well, yeah, easy math is if we want 10K a month, that's 120,000 a year. If you made 10%, 1.2 million. If you were to do it right away, if you can make 12% a year, it's $1 million, right? Because it's 1% a month. If you were to break it up that way, so pretty simple. But yeah, that's why I try to get people liquid. That's the next one, get liquid, because most of the time people are always locking their money in prison. They lock it in home equity, for example.
Yeah.
They lock it away in 401ks and IRAs and all that kind of stuff. And then they can't touch it till they're 60,
Yep. Yeah.
Where I'm like, let's find a way to get it out, right? That's why I use infinite banking to get liquid a lot of times, because it's like between banks and that we can have money available to use to get it out, to create passive income. I'll tell you, one of the things I find in real estate the most is that a lot of people aren't really calculating the return on equity very well. Because like I had this guy that was, he's down in San Diego. He had this property, and now he was very emotionally attached to it. Him and his wife were. He was net cash flowing $200 a month, but had 700,000 of equity in it. I was like, dude, that's a 0.3% return on your equity. You could literally cash it out, put in a CD, and make more money. And so I was like, let's take this out. Maybe 1031 it into other properties, right? And he fought me for 2 years. And then finally he just said, all right, I think it was about 2021. He's like, okay, I want to capitalize on the market, what it's doing right now. Let's do it. He did. He sold that crappy California property, because it's always California. It sucks, He moved it over to a bunch of properties in New Orleans. Not my first pick, but he had a family there. And so he loved that area. I was like, so he bought 6 properties. Now I just talked to him last year. Just a few years later, he's reinvested that cash flow to the point where now it's over $100,000 a year. Right?
Wow.
It was only, I remember he was just thinking like, I just got to put my head down for 6 years. By the way, we're about to go into the 6th year it would have been. Yeah. He was going to try to pay off that mortgage with all the extra cash flow he's getting. So he's aggressively paying down the mortgage. In 6 years, I was like, well, yeah, you'd only have $2,400 a month you'd be making on that property, where now it's over $100,000 a year. So that's the thing, is like, it's not just about having just liquid cash, but it's like, how do we get that cash available? There are places we could pull it from, or make some moves to where that money's available to then get it out to invest for passive income.
I love it. Chris, are you on social media? Where can people find you?
Yeah, we are. At Money Ripples, pretty much. I have my own individual Chris Miles or Chris C. Miles, depending on which platform you're looking at. We also have moneyripples.com, or feel free to follow the Money Ripples podcast that we have on YouTube or iTunes or Spotify or whatever. We have that even with our YouTube channel, the Money Ripples with Chris Miles page, where we do a lot of different videos and a lot of education there.
That's great. I'll be sure to put that all in the show notes. Chris, thanks so much for coming on. I know you got a jet. This was a lot of great info.
Yeah, it's been such a pleasure. I appreciate having me on, Bo.
Have a good one.